Hello students, welcome to another video on your direct tax law and planning. In this video, we'll continue with the same chapter, that is income from house property, but the topic here is annual value for self-occupied house. Here we will discuss how to find out the annual value in the case of self-occupied house. Similar to let out property, for finding out the annual value of self-occupied house, we have to take into considerations the different conditions the property is subjected to. Condition number 1, only one house under own occupation, annual value is taken as nil. If the assessee has only one house which is self-occupied, the annual value is taken as nil or 0. Second condition, more than one house under own occupation. The annual value of the house is taken as nil. The other house or houses are deemed to be let out. If he owns more than one house, annual value of one house is taken as nil. The other houses will be treated as deemed to be let out. Condition 3. House property consists of various independent units and one is under own occupation. The others are let out. The annual value of one unit is taken as nil and other units will be treated as let out. When the house is divided into various independent units, the annual value of the units under own occupation will be taken as nil. The other units will be treated as let out. Fourth condition, sometimes the house may be partly let out or partly self-occupied. In this case, if the units are inseparable, which means we cannot differentiate between the let out and self-occupied units, the whole house will be treated as let out house. Okay, and no benefit of self-occupation shall be allowed. If units are separable, each unit is treated as a separate house and shall get treated respectively of their usage. Fifth condition, the house property, when house property is let out for a part of the year and under self-occupation for another part of the year. In this case, the property is treated as let out. However, the actual rent is taken only for the number of months in which it was let out. As such, it gets the same treatment as for its unrealized rent. Another important, before we go to another topic, let's solve some problem. This is problem number 1. This is your question. In this question, we have to find out the net annual value of the house property for the previous year 2016-17. In this problem, Mr. X owns a house at Chandigarh. The property is used in the following manner. 1/3 of the house is used for own business, 1/3 of the house is used for own residence, and another 1/3 of the house is used by a tenant to whom it was let out at rupees 3,000 per month and it was self-occupied for 1 month, which means it was let out for 11 months and self-occupied for 1 month during the previous year. The MRV of the house is rupees 96,000 per annum, on which municipal levies 10% tax. Okay, listen carefully. These taxes are paid by the occupants and not by the assessee. Compute the net annual value of the house property for the previous year 2016-17 if each portion is an independent unit. So this is how we solve the problem. Okay, the house property is divided into 3 units, that is 1/3 each. Unit A, 1/3, which is used for own residence. Okay, NAV for own residence will be treated as nil. Okay, the second unit, that is 1/3 portion which is used for own business. This will not come under the heading income from house property. It will be calculated in another heading for business, for profit and gains. Here the NAV is also nil. Unit C, 1/3 portion let out for 11 months and self-occupied for 1 month. Here the actual rent will be taken for 11 months only, if you remember the conditions. Actual rent received for 11 months, rupees 33,000. Okay, because the rent per month is 3,000. The MRV is taken for 1/3 of 90,000 because we are calculating only for unit C, which is 32,000. Whichever is higher is your ARV, actual rental value. So 33,000 is higher. Municipal taxes paid by the owner. If you remember, municipal taxes were paid by the occupants and not by the owner. So it comes to nil. NAV of let out portion will be 33,000, and the NAV of house property, since the other units are nil, the house property, the net annual value of house property will be 33,000. I hope that is understood. Deductions under section 24A. These are also important points which you have to keep in mind while doing your problems regarding your income from house property. Section 24A under Income Tax Act has provided certain items that can be deducted before arriving at the final NAV. Okay, these deductions are allowed on NAV. That means we have to deduct from your net annual value. Only in the case of let out and deemed to be let out. These deductions are allowed only in the case of let out or deemed to be let out. Also, deductions are allowed regarding the expenses incurred by the owner. Okay, these deductions are allowed at 30% of net annual value. Actual expenses are not to be considered. The actual expenses borne by the owner is not to be considered, but 30% of the annual value will be given as deduction. This standard deduction is available even if the owner has not incurred any expenses. Okay, even if the owner has incurred zero expenses, this deduction is still allowed. Deductions under section 24B, that is on interest on housing loan. Many a times the owner has to take a housing loan for construction or acquisition of a certain house. So if a housing loan is taken for such purpose, deductions will be allowed for the computation of tax. Loan taken or amount borrowed for purchase, construction, repairs or innovation etc. of the house property. This loan can be for the purpose of purchase, construction, repairs or innovation. Okay, the interest paid or payable on housing loan is allowed as deduction while computing house property income. Okay, only the interest is allowed as deduction. Limit on deduction. Here, in case of let out or deemed to be let out, there is no limit on the deduction. If the purpose is for purchase, construction or repair. In case of self-occupied house, okay, the homeowners can claim a deduction up to rupees 2 lakh. This is the limit. That means it cannot be more than 2 lakh. Okay, and rupees 1.5 lakh if you are filing returns for the financial year 2013-14. This is only for the year 2013-14 on their home loan interest. If the owner or his family reside in the house property, the same treatment applies when the house is vacant. Even if the house is vacant, the same condition will apply. If you have rented out the property, the entire interest on the home loan is allowed as deduction. Okay, if it is let out, the entire interest will be allowed as deduction. But if it is self-occupied, there is a limit to the deduction, that is, it can be allowed up to rupees 2 lakh. The deduction on interest is limited to 30,000 if the homeowner failed to meet the conditions given. These are the conditions. If the house owner fails to meet the following conditions, the limit on the deduction will further be reduced to rupees 30,000. The home loan must be purchased and must be for purchase and construction of the property. The loan must be on or after the 1st of April 1999. The purchase or construction must be completed within 5 years from the end of the financial year in which the loan was taken. These are the three conditions which must be fulfilled in order to get the deduction up to rupees 2 lakh. If these three conditions are not fulfilled, the limit on the deduction will be further reduced to rupees 30,000. Pre-acquisition or pre-construction period interest. Many a times housing loan are taken for constructing houses. In this case, the period from the date of borrowing to the date of completion or acquisition of the house will be known as the pre-acquisition or pre-construction period. For the purpose of adjusting deduction, the pre-acquisition or pre-construction period will be taken from the date of borrowing to the 31st March immediately preceding the date of completion or acquisition. Here an example is given. For example, Mr. A has taken a loan on 1st for 2013 for constructing a house. The construction was completed on the 1st of July 2015. So your pre-construction period will be from the 1st for 2013, the date of borrowing, to 31st March 2015, that is the 31st March immediately preceding the date of completion. Okay, since the date of completion is 1st of July 2015 and 31st March immediately preceding 1st July 2015 is 31st March 2015. Okay, the pre-construction period will be for two previous years, that is 2013-14 and 2014-15. How do we treat pre-construction or pre-acquisition interest? Interest for pre-acquisition or pre-construction period shall be allowed as deduction in 5 equal installments starting from the previous year in which the house is purchased or construction is completed. The total amount of pre-construction interest and interest on housing loan that can be claimed in a year should not exceed rupees 2 lakh in any case. Okay, the first condition, the pre-construction or pre-acquisition period interest will be allowed as deduction, and this deduction will be divided into 5 equal installments. This deduction will be allowed from the year of completion of construction or acquisition. However, the total amount of this interest on each year must not exceed rupees 2 lakh. This is another problem so that we can understand how to apply the deductions further, the different conditions and deduction under section 24A and B further. Find out the deduction under section 24B from the given conditions for the current previous year 2019-20. This is the date of loan 1st April 2016. Date of completion of construction is your 30th June 2018. Annual interest is rupees 50,000. Working notes. Pre-acquisition period will be from the date of borrowing, that is 1st April 2016 to 31st March 2018. The 31st March immediately preceding the date of completion, which is 30th 6 2018. Okay, this pre-acquisition period will go on for two previous year. Interest for previous year 2016-17 will be rupees 50,000 as given in question. Interest for previous year 2017-18 50,000. Total pre-construction interest is rupees 1 lakh. Deduction of interest for previous year 2019-20. Current year interest, that is current year interest plus 1/5 of pre-construction interest. Annual interest is 50,000 plus 1/5 of rupees 1 lakh, which will come to 70,000. So this is your total deduction. That's all for this video. We'll continue in the next slide and video.